$9 a day doesn't feel like an investing plan. It feels like something you spend without thinking. Coffee, parking, small charges that disappear. But what if that exact $9 used the right way is enough to build a $1.8 million portfolio, or a portfolio that pays you $6,750 a month? In this video, I'm going to show you a simple 4-index fund setup that makes that kind of outcome possible. You'll see what each fund does, how they work together, and how the same setup can be used for growth or for income, depending on what you want your money to do. And in the end, I'll show you and Josh how sticking to this setup with nothing more than $9 a day can realistically grow into either a $1.8 million portfolio or a monthly income of around $6,750. To make that work, the first thing we need isn't a fund. It's a structure that gives every dollar a job and lets the whole portfolio move together. Most people think investing fails because they pick the wrong stocks. In reality, it fails because portfolios are unbalanced. They lean too hard in one direction and break when conditions change. That's why I use what I call the 4-engine portfolio framework. Instead of thinking in terms of good or bad investments, this framework looks at what each part of your portfolio is supposed to do. Just like a machine needs different components working together, your money needs multiple engines running at the same time, each with a specific role. The first engine is the foundation engine. This is the core. Its only job is to own the market as a whole. No predictions, no sector bets, no guessing winners. It provides stability, diversification, and a base that everything else builds on. The next engine is the stability engine. Markets don't move in straight lines, and this part exists for the uncomfortable moments. It reduces swings, absorbs shocks, and helps you stay invested when fear would normally push people into bad decisions. The third engine is the growth engine. This is where acceleration comes from. I'm willing to accept more ups and downs here in exchange for higher long-term potential. This engine is what shortens the timeline to meaningful wealth. The final engine is the income engine. This is where ownership turns into cash flow. Dividends start small, but over time they compound and grow alongside the portfolio, eventually becoming usable income. When all 4 engines work together, the portfolio becomes balanced, durable, and adaptable. Which raises the obvious question: if this setup is so structured, why not ignore it and just buy a few great stocks instead? Here's why. Most investors don't lose money because the market doesn't work. They lose money because they try to beat it. Stock picking feels productive because it involves action. You research, you compare, you react. But activity and results are not the same thing. When you pick individual stocks, you have to be right repeatedly. One bad earnings report, one regulation change, or one unexpected event can undo years of progress. When a portfolio holds only a few companies, every headline carries weight. That pressure often leads to selling too early, buying too late, and constantly shifting direction. Index funds work differently. Instead of betting on individual outcomes, you own the market itself. An index fund holds hundreds or thousands of companies at the same time. If one company struggles, others continue to grow. You don't need to predict which business will win next because the index naturally shifts as the economy changes. That structure removes a major source of mistakes. You stop reacting to short-term news and price swings. You stop trying to time entries and exits. Instead, you stay invested and let the market do the work. Over long periods, broad markets have grown consistently. Index funds capture that growth with fewer decisions, lower costs, and far less stress. Once people realize stock picking is difficult, they often fall into a different trap: chasing dividends. On the surface, it sounds safer. Instead of betting on price growth, you focus on income. But this approach creates its own problems when it's done without structure. High dividend yields usually exist for a reason. Often the stock price has already fallen because the business is under pressure. That high yield looks attractive, but it's not guaranteed. When profits decline, dividends get cut. When dividends get cut, prices often fall even further. Investors lose income and capital at the same time. Stock picking and yield chasing are different on the surface, but they share the same mistake. Both focus on short-term signals instead of long-term systems. Both require constant judgment calls. Both increase the chances of selling at the wrong time. A better approach separates growth and income into different roles. Growth builds the portfolio first. Income comes later when the asset base is large enough to support it. This reduces pressure and allows dividends to grow naturally instead of being forced early. Index funds help avoid both of these traps by taking decision-making out of the process and keeping the focus on a structure that stays consistent over time. But not all index funds are good investments. Some look diversified but aren't. Others pay attractive dividends but grow slowly. That's why having a few clear rules matters more than chasing whatever looks popular. The first rule is diversification. A solid index fund should spread your money across hundreds or thousands of companies. This reduces the impact of any single business failing and removes the need to guess which sector will perform best next. The second rule is sustainable growth. A high yield today doesn't matter if it can't last. What matters is whether dividends and earnings can grow steadily over time. Growth keeps compounding alive. The third rule is cost. Fees might look small, but over decades they eat away at returns. Index funds work best when expenses and turnover stay low, allowing more of your money to remain invested. The final rule is consistent across market cycles. A good fund doesn't need to win every year. It needs to survive bad years and participate fully in good ones. Stability matters more than short-term performance. When you apply these rules, or filter if you like to call it, most funds drop out immediately from the big list of index funds out there. What remains are a small number of index funds that each do one job well. Those are the building blocks of a system that we are about to build. And in the end, I'll show you how sticking to this setup with nothing more than $9 a day can realistically grow into either a $1.8 million growth-focused portfolio or a monthly income of around $6,750. That brings us to the most important piece of the whole setup, the foundation, the part everything else rests on. And that role is filled by the Fidelity Zero Total Market Index Fund, or FZROX for short. At its core, this fund is about owning the entire US stock market in one place. It holds large companies, mid-sized companies, and smaller ones too. Fast growers and steady earners. Different sectors, different styles, all bundled into a single fund. The fund seeks to deliver total returns that reflect the overall performance of the US stock market and is domiciled in the United States. Looking at the holdings data, FZROX owns more than 2,500 companies across all major sectors. Technology takes up the largest slice, followed by areas like financials, healthcare, and consumer businesses. This isn't a design choice meant to chase trends. It simply reflects where market value and earnings are concentrated in today's economy. Large companies naturally carry more weight, while smaller companies add breadth and diversification underneath. That broad mix is exactly why this fund works so well as a foundation. Its performance closely follows the overall US market. No extreme spikes, no dramatic detours, just steady participation in long-term growth. That's what the core of a portfolio is supposed to do. On the 5-year performance chart, FZROX closely tracks the broader US market, moving almost in step with the S&P 500 without sharp spikes or deep drops. Over that period, the fund delivered a 73.38% total price return, compared to 80.54% for the S&P 500. That gap makes sense. The S&P 500 only holds large companies, while FZROX includes thousands of smaller ones too. What matters is that it captures most of the market's upside while spreading risk much more widely. Based on the metrics, FZROX has averaged about 14.54% annual share price appreciation, which aligns well with long-term market growth. That steady, diversified performance is exactly what you want from the foundation of a portfolio: reliable growth without unnecessary volatility. Risk metrics make its role even clearer. Holding roughly 2,550 stocks spreads risk across the entire market instead of concentrating it in a handful of names. The top 10 holdings account for about 35.02% of the fund, which reflects how dominant the largest US companies are, but the remaining exposure is spread across thousands of businesses. Turnover is just 3%, meaning the fund trades very little. That helps keep taxes and hidden costs low. Now let's look at the dividend data, which confirms that income is not the primary objective here. FZROX has a current dividend yield of about 1% and a dividend growth rate of roughly 7.19%. Early on, that income barely moves the needle. That's intentional. This fund's job is growth, not cash flow. Cost is where this fund really stands out. FZROX has a 0% expense ratio. That means every dollar you invest stays invested, and over decades, that alone can make a massive difference. When this gets tied back to the $9 a day idea, the early years feel slow. After 10 years, it is projected to grow to roughly $67,000. By year 20, it would reach around $335,000. By year 30, it compounds to about $1.39 million. At that point, dividends are still modest, roughly $1,300 per year or just over $100 a month, but that is not its main function in this portfolio. A foundation handles growth, but you also need stability when markets get rough, and for that I use the Schwab Target 2045 Index Fund, or SWYHX for short. SWYHX is a target date index fund built for people aiming to retire around the year 2045. Instead of betting on one type of investment, it spreads money across US stocks, international stocks, and bonds. It follows a set path that slowly reduces risk as time passes, without needing constant decisions along the way. In plain terms, this fund doesn't depend on one market or one asset class to behave perfectly. As the years go by, the fund gradually shifts from being more aggressive to more stable, which is exactly what a stability engine is supposed to do. Just like the previous fund, this one is built to keep costs as low as possible. SWYHX isn't technically zero cost like FZROX, but the expense ratio is very close to zero. It uses index-based building blocks instead of active managers, so there's no expensive decision-making layered on top. Right now, SWYHX still leans heavily towards stocks, which makes sense given its 2045 target date. US equities make up the largest share, followed by international stocks, with a smaller portion in bonds and fixed income. That combination allows the fund to participate in global growth while smoothing out swings through diversification across regions and asset types. The performance data reflects this balance clearly. On the 5-year chart, SWYHX rises steadily but lags the S&P 500, avoiding the sharp swings seen in pure growth funds. Over this period, the fund delivered a 41.98% total price return compared to 80.54% for the S&P 500, showing lower upside in exchange for smoother performance. The dividend data reinforces this role. SWYHX offers a current dividend yield of about 2.02%, noticeably higher than a broad total market fund like FZROX. More important than the yield is how that income grows. It also has a 5-year dividend growth rate of roughly 12.38%, meaning payouts have increased consistently over time. This provides a rising income stream while the portfolio continues to compound. Alongside that income, SWYHX has averaged about 8.64% annual share price appreciation, keeping growth steady without taking on excessive volatility. Compared to pure equity funds, SWYHX shows lower volatility due to its bond exposure and global diversification. The turnover ratio of about 14% reflects the fund's ongoing adjustments as it follows its glide path. Now here's what a $9 a day investment is projected to look like in this fund. By the end of the first year, you would have invested about $3,285. Over time, the projections start to separate this fund from pure growth strategies. By year 10, the account is projected to grow to around $55,000, with dividends projected at roughly $1,000 per year. That's the first point where income starts to show up in a noticeable way. By year 20, the projections show the balance reaching about $232,000, with annual dividends projected at around $8,000. By year 30, this index fund investment is projected to compound to roughly $896,000. Annual dividend income is projected near $46,000, or about $3,800 per month. Growth is still there, but stability and income have clearly taken the lead. That shift is exactly what stability is meant to do. Growth leads early on. Over time, income and balance naturally take on a bigger role. The data backs it up. SWYHX brings diversification, rising income, controlled risk, and automatic adjustment as time passes. Now, there's one more engine to cover. After that, I'll bring all 4 index funds together into a single portfolio. And by the end, I'll show you how this setup with $9 a day can realistically lead to either a $1.8 million growth-focused portfolio or about $6,750 a month in income. But first, let's look at the final growth-driving fund. For that, I use the Fidelity Nasdaq Composite Index Fund, or FNCMX for short. FNCMX is built to track the Nasdaq Composite Index, which is heavily tilted toward technology and innovation-driven companies. It focuses on businesses that are reinvesting aggressively, expanding quickly, and trying to grow earnings faster than the broader market. The foundation owns the market. Stability smooths the ride. FNCMX is here to add speed. It leans into companies shaping where the economy is going, even if that means more ups and downs along the way. The fund holds close to 2,900 companies, but it's far more concentrated than a total market fund. Technology makes up more than half of the portfolio, followed by communication services and consumer cyclical stocks. The top 10 holdings carry a lot of weight, with names like Nvidia, Microsoft, Apple, and Amazon leading the way. That concentration increases risk, but it also magnifies upside when innovation-driven companies perform well. As for the dividends, FNCMX isn't built for income. The current dividend yield sits around 0.51%, and the 5-year dividend growth rate is about 6.91%. Dividends exist, but they're small and secondary. Growth is the main objective. That shows up in the numbers, with average annual share price appreciation around 17.74%, well above broad market funds. But those higher returns don't come for free. They come with risk, and this fund doesn't try to hide it. Even though SMCMX holds close to 2,900 stocks, the risk is far more concentrated than it looks. The top 10 holdings make up about 60.41% of the fund. That means when large technology companies move, this fund moves with them. Big gains can stack up quickly, but pullbacks can feel sharper too. Turnover stays low, around 2%, which helps keep trading costs and tax drag under control. So the volatility here isn't coming from constant buying and selling, it comes from focus. This fund is intentionally concentrated in growth-heavy, innovation-driven businesses, and that concentration amplifies both the upside and the downside as market cycles play out. Based on the metrics I shared, let's connect this to the future projections. With a daily investment of $9 per day, the projections show the account growing to around $77,000 by the 10-year mark. Income remains small, which is exactly how this fund is designed to work. By year 20, the projections show the balance reaching approximately $476,000. And by year 30, this approach is projected to compound to roughly $2.52 million with very little dividend income. That's the trade-off: speed and acceleration in exchange for bigger swings and income. And that's exactly why this fund works best as part of a system, not on its own, especially when the next piece of the portfolio is designed to turn that growth into something more stable and usable over time: income. And for that, I use the Schwab International Index Fund, or SWISX for short. SWISX focuses on developed markets outside the United States. It invests in large and mid-sized companies based in places like Europe, Japan, and other established companies. These are markets that tend to be more mature, more stable, and more income-oriented than the US. In simple terms, this fund does what US-focused funds don't do very well. While the US market leans heavily toward growth and technology, international markets tend to pay higher dividends and move at a slower pace. That makes SWISX a natural fit for the income engine. The fund holds 709 companies across developed international markets. Sector exposure is spread out, led by financials at 24.28%, industrials at 19.1%, and healthcare at 11.43%. No single sector dominates the portfolio. Risk is spread evenly, and the top 10 holdings make up only 12.88% of the total assets. That low concentration helps stabilize returns and reduces reliance on any one company. Dividend data is where this fund stands out. SWISX has a current dividend yield of about 2.46%, which is significantly higher than the US total market and growth-focused funds. More importantly, the dividend growth rate is strong, with a dividend growth rate of approximately 19.73%, with an annual share price appreciation of 6.42%. Performance data confirms the trade-off. Over the 5-year chart, SWISX has delivered a total price return of about 33.82%, well below the 80.54% return of the S&P 500 over the same period. This slower growth isn't a flaw. SWISX is built for stability and income, not aggressive price gains, making it better suited for investors who prioritize steady returns and long-term income over maximum growth. Now here's what a $9 a day investment is projected to look like in this fund. By year 10, projections show the account growing to around $57,000, while annual dividends are projected near $4,000. And by year 20, projections show the balance reaching approximately $540,000, with annual dividend income projected around $107,000, or close to $9,000 per month. These projections represent an extreme compounding scenario built on long-time horizons and strong dividend growth. The takeaway isn't the exact number, it's the shift. Over time, income takes over as the main driver, eventually overtaking price growth itself. That's why SWISX belongs in the income engine. Growth builds value, stability protects it, and income is what turns it into something usable. Now you have one index fund for each role: a foundation for broad market growth, stability to smooth out volatility, growth to accelerate compounding, income to eventually turn that growth into cash flow. Up to this point, we've looked at each fund on its own, but investing doesn't work in isolation. The real question is what happens when you combine these 4 funds into a single system and let them work together over time. Here's where flexibility comes in. Depending on where you are in life and what you want your money to do, the same 4 building blocks can be used in different ways. Some investors want income sooner. They're thinking about dividends, cash flow, maybe even early retirement. Others don't care about income right now at all. They want to grow their portfolio as large as possible and let compounding do the heavy lifting for decades. Same funds, different priorities. To see how that works in practice, let's start with a dividend-focused portfolio. This version is built for anyone who likes the idea of getting paid to own investments, but doesn't want to give up long-term growth to do it. The goal is to combine steady growth with rising income so dividends become meaningful over time. For an income-focused mix, a good way to distribute the investments is to lean into dividends and stability without walking away from growth. A balanced approach is to put 40% into SWYHX to anchor the portfolio with stability, income, and risk control. Another 40% goes into SWISX, since that's the fund doing most of the income work through higher and growing dividends. Those two form the core of the income-focused mix. The remaining 20% is split evenly. 10% goes into FZROX to keep broad US market growth working in the background, and the final 10% goes into FNCMX to add a layer of faster growth so the portfolio doesn't stall. Now let's look at what this mix is projected to produce once everything is working together. Each fund brings a different level of income. FZROX has a dividend yield of about 1%. SWISX yields around 2.46%. SWYHX comes in at roughly 2.02%. FNCMX sits much lower at about 0.51%. Since the portfolio isn't split evenly, those yields need to be weighted by how the money is actually allocated. With 40% in SWYHX, 40% in SWISX, 10% in FZROX, and 10% in FNCMX, the income breaks down like this. SWYHX contributes about 0.81%. SWISX contributes roughly 0.98%. FZROX adds about 0.1%. FNCMX contributes close to 0.05%. When combined, the projected portfolio dividend yield comes out to around 1.94%, which fits the goal of an income-leaning portfolio that still keeps growth in play. The same weighting can be applied to growth. When dividend growth is weighted across the portfolio, it's projected to average around the mid-teens per year, driven largely by SWISX and SWYHX. Weighted share price appreciation is projected to land around 9.25% annually, reflecting a mix that favors income and stability without giving up long-term growth. Now here's what happens when you invest $9 a day in this income-focused portfolio. By year 10, projections show the account growing to around $57,000. By year 20, it's projected to reach roughly $261,000. By year 30, this mix is projected to compound to about $1.19 million. At that point, dividends alone are projected to generate around $81,000 per year, or roughly $6,750 per month, without changing the strategy. This is what a dividend-focused strategy looks like when it's built correctly. Now let's flip the priority. Everything you've seen so far still applies, but this time the goal isn't income, it's maximum long-term growth. This portfolio is built for investors who don't need cash flow right now and are willing to let compounding work as aggressively as possible for decades. The building blocks stay the same, only the weight changes. In the growth-focused portfolio, 70% of the money goes into FNCMX. This is the engine. It's where innovation, technology, and aggressive reinvestment drive returns. 20% goes into FZROX to keep broad market exposure and prevent overconcentration in a single theme. The remaining 10% is split evenly, with 5% in SWYHX for balance and risk control, and 5% in SWISX for global diversification and a small income base. This allocation intentionally sacrifices current income in exchange for faster portfolio expansion. FNCMX dominates the outcome, while the other funds reduce risk without slowing momentum too much. When you look at the weighted numbers, the portfolio's dividend yield drops to about 0.78%, which is expected. Dividend growth averages around 7.88%, but income is not the focus here. Growth is. Weighted share price appreciation is projected at roughly 16% per year. Now here's what that's projected to look like over time with the same $9 a day habit. By year 10, Projections show the account growing to around $72,000. By year 20, it's projected to reach roughly $397,000. And by year 30, this growth-focused mix is projected to compound to about $1.85 million. Dividend income stays small the entire way. Even by year 30, dividends are projected at around $1,000 per year, or roughly $80 per month. Compared to the dividend-focused portfolio, where dividends are projected at around $81,000 per year, the difference comes out to about $80,000 per year in income. Now look at the portfolio values. By year 30, the growth-focused portfolio is projected to reach about $1.85 million, compared to the dividend-focused portfolio, which is projected to grow to about $1.2 million. The difference in total value comes out to roughly $650,000 in favor of the growth-focused portfolio. Same starting habit, same $9 a day, same 4 funds. The outcome can be whatever fits the life you want to build. Want to know how to make $6,000 a month in dividends with just $25 a week? Click the video on screen to find out.